And welcome back, options traders. Well, here's a good question for the group. What's the difference between the VIX and implied volatility? And I'm doing this video on behalf of one of the traders in our group who asked this question and said, I'm just really confused between these two. And I'm sure that other traders have the same question because you do hear these terms thrown around a lot, VIX and implied volatility. And one of the reasons it can seem a little confusing is that they're really exactly the same idea. They're just being applied in different ways. So let's start with implied volatility. So we've talked about this before, but for a quick refresher, remember what implied volatility is. It is the volatility number that's required to put into a pricing model to produce the current options price. And really all we're doing is that you could think of it as though we are reverse engineering a pricing model. So for instance, let's say that we have a stock trading for 100, strike is 100, risk-free interest rate is 5%, time to expiration is 30 days, and volatility is 20%. If we put these 5 factors into a pricing model, it's going to tell us that this option should be trading for $2.50. And that number is actually what we call the fair value. And what this means is that if you were to buy hundreds of options just like this, or sell them, not counting commissions, you would just break even in the long run. That's what it means to be a fairly valued asset. It's not favoring the buyer, it's not favoring the seller. So this is one of the reasons that we turn to a pricing model to say, under these conditions, what should this option be trading for? Now, of course, in the real world, we don't really know. People might bid this options price higher or they might bid it down. So it all depends on this number right here, the volatility. That's really the true unknown in the model. So let's do an example like that. Let's say that we've got these factors, we look on our broker's platform, and we find that the option is not trading for $2.50, but instead is trading for $4. Well, if you'll notice, these first 4 factors are essentially locked. We can't change the stock price because it is trading for 100. We can't change the strike because that's the exercise price that we're trying to evaluate. Risk-free interest rate, there's a little bit of wiggle room there, but for the most part, we have to stick with, let's say, a T-bill that matures in 30 days. Time to expiration, that's fixed. That's a known by the market. We can't change that. But we could change our volatility assumption. Remember, the volatility assumption is up to traders because what we're trying to determine here is what will be the volatility over the life of the option. Now, sure, we can look at past volatility, historic volatility averages to get a good guess, but that's not enough to produce the current market price. So if the market is actually pricing this option at $4, we would have to change the volatility number to try to get this to become 4. So again, we can't change any of these factors in black, but if we keep trying some different numbers here, we would eventually find that if we change volatility from 20% to 33, we would in fact get a option price of 4. And this number right here, this volatility of 33%, would be called the implied volatility. It's a volatility that we are deriving based on a known options price. And we are therefore inferring that, well, if options traders are willing to pay 4 or to sell for 4, they must believe that the future volatility will be 33%. Otherwise, nobody would be willing to trade at this number. So notice there are really 2 different ways we can use a pricing model. One, we could look at these 5 factors, put them in, and come up with an options price of what it should be. But if we have a real-world options price, we can, again, reverse engineer it, and we can say, let's look at these factors and figure out what volatility would be required to make this options price true. And again, this would be called the implied volatility. It's a volatility number being implied just by the very fact that options traders are willing to trade for $4. So that's the basics of implied volatility. What about the VIX? What is this all about? Well, it stands for the Volatility Index, and what it is it shows the implied volatility for the S&P 500 index. So there's been a huge history of the VIX. You can read about it at the CBOE's website, Chicago Board Options Exchange. But it was introduced in 1993. Then they came up with a new calculation for it 10 years later in 2003. But the super basic idea is that they use SPX options, S&P 500, with more than 23 days to expiration, but less than 37. And they do this weighting scheme. It's a mathematical weighting so that it comes up with a hypothetical 30-day option. So what it's really doing with the VIX is it measures the 30-day expected volatility based on almost all of the options that we're seeing on the quote board within 23 to 37 days. What is the volatility that the market is projecting based on these prices? That's really the question that the VIX is trying to answer. So here's a long history of it from 1990 through the present, and you can see that it just goes sideways. And that's an important property for options traders to understand. Volatility is just mean reverting. And what that means is that when we get into periods that are relatively high, like up into here, probably going to come back down to the long-term average. If it gets really high, like it did during the financial crisis, 07-08, probably going to revert. Here's coronavirus, pushed 85 or so in both of these periods. The long-term average is about 20. So conversely, if the VIX gets below 20, there's a good chance you're going to see it start to curl up towards that long-term average. So this is a real basic way that traders will figure out which strategies to use. Are we in a low volatility environment? Are we in a high volatility environment? Can I expect it to rise? Can I expect it to fall? And based on these assumptions, which are really statistically valid, we can come up with better strategies. But the main thing to answer this question is that when you're looking at the VIX, which is what this chart is, it is a history of the implied volatility only for S&P 500 options. Now, yes, it is true that if you're seeing relatively high periods of volatility on the VIX, like here, 2007, 2008, yes, you're going to find that pretty much all options will have high volatility. During coronavirus, we could look at the VIX, see that it's just spiking off the chart, and we would be pretty sure that no matter which option you pulled up, Facebook, Amazon, Google, they are all going to be trading at high volatilities. So that's another good use of the VIX. It just gives you a general idea of the overall volatility in the market. So I hope this helps to answer your questions, and if you have more, please post and we can cover those in a future video. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.